Welcome back, folks. Before I get into it, I just want to give you a little bit of a heads up. We will be doing weekend edition postings on Sunday mornings. The reason why I need to do multiple sets of these videos for the user groups, and we have a lot of people coming in, so it creates more production time requirements. So it will require more time to be built into processing them, applying all the watermarks and such. So the weekend edition will always be around the 10 o'clock to 11 o'clock time period. That's what I'm aiming for. It might be a little bit late, it might be a little bit early, depending upon how fast we can get them all done. But it takes time, obviously, to make multiple renditions of the same video. I have to apply watermarks and user groups and such to be able to track things, and it's one of those unfortunate things because there's a lot of people in the world that are not upstanding and have character. So it is what it is. Please don't complain to me and ask me to do it sooner, because your life schedule and such may demand that you have it sooner. I don't have time constraints in our agreement. I just say that there's a weekend edition and a Wednesday video. All right, so it is what it is. Okay, so I'm just letting you know that's the normal delivery going forward. So it'll be on Sunday mornings that we will have the weekend edition. Okay, I know some of you live in the UK, and this is probably an evening time when you're about to unwind and settle in for the rest of the evening on Sunday. But there has to be a way for me to, get all these things done, and I obviously can't do it all on a Friday evening. Okay, so it takes a lot of work for us to get it done. So therefore, you all know now. Okay, so please don't email me, don't ask, can we do it sooner, because it won't happen. Okay. All right, so this is the weekend edition for January 17th, 2021. And the price action lesson in this edition is going to be the Corn Futures Mega Trade. All right, here's the economic calendar up to Wednesday. And obviously on the Wednesday midweek review, I will include Thursday and Friday's economic calendar. On Monday, we have a bank holiday in the U.S. and 8:30 a.m. medium impact GBP. We have a speaker. On Tuesday, there's an absence of any real significant news drivers. And on Wednesday, 8:30 a.m., medium impact for Canadian dollar CPI, and 10 a.m., high impact monetary policy, bank rate statement, overnight rate for Canadian dollar. And there's a press conference for Canadian dollar that will be obviously tentative. And then Wednesday, the high impact news event will be the President-elect Biden speech. 7:30 p.m. high impact employment change and unemployment rate for Australian dollar. So clearly there is some big movement expected on Wednesday. There's a lot of uncertainty in the United States around this particular week, and I have mentioned this multiple times. I'm not going to beat you up with more of it here, but just know there's no way for anyone to expect a specific delivery of price on a week like this. We don't know what's going to happen. Personally, I think there's a false flag in the works. Okay, a false flag is an event that makes it look like somebody else did something when they themselves did it. And I'll just leave that right there, and you can make what of it you may. It is not conspiracy theory. It's not fear mongering. It's just common sense. It just looks odd. Okay, and if you looked in Washington D.C., it looks like a militarized zone. Like, it's weird. Like, it's right out of a movie. And one of the things that I found interesting is that they're putting razor wire on the inside of the fence, which my father, my biological father here, has a prison sentence, and he was a contract murderer. And it probably took you by surprise. Where did this come from? It's salient, trust me. He was being held in the Maryland House of Corrections in Jessup, Maryland for a long time. And every time we went up to visit, which wasn't frequent, but when we did, I always noticed that they had multiple fences, perimeter fences, that had barbed wire and razor wire at the top of the fence, but it had rows of razor wire on the inside of the fence. Not the outside, the inside. And if you take a look at that and study what a prison is designed to do, it's designed to keep people in, not out. So if they're putting layers of razor wire on the ground inside the fence, in the perimeter fence in Washington, D.C., to me, I find that as a bit odd. I find it interesting, because you would think that they're trying to keep protesters out, right? But they're doing things that, by all appearances, it really looks like someone's trying to be kept inside a fence. So I'm interested to see what happens this week. I just toss that out there for you to consider it. A little bit of tinfoil hat, if you will. All right, so here's the dollar index, or daily chart. And as I promised, and I made sure that I was on point to this time, we're going to show you the chart, and that way you get an opportunity to look at the chart, annotate. Now, here's several ways you can do this. If you want the long way around doing it, you can try to pause the video, set your chart up, scroll it around so it kind of looks like this one, and then dress it up, or take a screenshot of this and then use a image editor like Paint. Paint is like usually what I usually grab, and I annotate things if I want to make a quick post on like my YouTube channel or something like that. I'll use Paint, and you can annotate your chart that way. Obviously, there's a lot of different image editors you can use that can add text and such to the chart. So there's however way you want to do it, it's fine. There's no real right way of doing it, but I think the longer way around doing it and more time would be to try to scroll your chart to make it look like this as much as you can. And if you want to do that, then by all means do it. I have other people that are just simply taking my chart and printing it when it's like this, and then they hand draw in their annotations, and then they put that in their journal. They're using like a 3-ring binder approach, which is, again, there's nothing wrong with that either. That's how I first started. So we're looking at the daily chart, and obviously I'm about to show you the annotations. So if you're not ready, pause the video. Okay. All right, so here is, again, the annotations that we had in the previous week's discussion. And we've had multiple confirmations that we're looking for a run into that premium level. This range high to this range low is still the dealing range that I've outlined for this time frame. And the equilibrium price level is here. And it looks like we're trying to gravitate towards that. The darker lined levels here, again, that's the weekly fair value gap. I mentioned that we will constantly have the weekly perspective in the commentaries now. So while I may not have the weekly chart per se, the annotations and or the perspective that the weekly chart gives me, or us, will always be included in the analysis. When it's salient, I will add the actual chart, but nothing really happened a whole lot in terms of the weekly charts candles that would warrant me showing you another chart. So I want to kind of keep the videos as short as possible, because I'm going to do a lot of talking, and having more charts when it's not necessary is just going to add additional time to the video. All right, so we have the fair value gap on the weekly, and then we have a volume imbalance in here. Buy side liquidity resting above this level here as well. And we have low resistance liquidity run signatures within a counter trend environment. So we were anticipating some increase in the price, at least to try to get to a equilibrium or a premium level. It doesn't necessarily have to trade up into the fair value gap or into the optimal trade entry levels that's annotated here. And again, using the high to the low, that's the range that I used for these two, 79% and 62% respectively. So there's multiple premium arrays that are gathered in this area and above the premium equilibrium threshold that we're waiting for. So it looks like we're trying to get there. I mentioned in the previous discussion that we do have that small little fair value gap, and we did come down on that on Wednesday. So it'll be interesting to see if it runs higher. And I did not want to see this low violated on this day. And we had Thursday a little bit of a mixed bag, and then finally, Friday it really took off and started running. So we're going to give it the benefit of the doubt and assume that it's still reaching for this. Now, I have not abandoned the long-term bearishness on the dollar. I just feel that the Fed is more or less promoting this idea that maybe we're getting closure with the presidency if the inauguration goes in without any hitch, no drama. Hopefully, traders will see that as a conclusion to all this, and then we can start working towards normalcy in the markets. I don't expect that, but it's being painted as such. So we'll see what happens. Order block, the last two down closed candles, price obviously made an attempt to get into that as well. So everything in here that I've outlined for potential sensitivity leading to higher prices, it was delivered. All right, so the hourly chart on dollar. Again, same thing. Take a look at your chart here and pause the video if you don't want to see the annotations. And I'm adding them now. All right, so here is our hourly dollar index. We have our fair value gap in here after running into the daily fair value gap. Okay, so that's that daily fair value gap that I mentioned on Wednesday. And we traded down into optimal trade entry from the low to the high. Look at that range. It trades down into it, and also consequent encroachment of the fair value gap here, taking sell side liquidity out. What was the underlying order flow that I've outlined? We were looking for higher prices on the dollar for the daily chart relative to that framework that I've outlined. And before we went into the hourly chart, you know what I'm referring to. So all those annotations leading to trading to equilibrium or premium on the daily basis for dollar. That sets the tone for short-term order flow being bullish. So when we see this drop down like this, they were not expecting this low to be taken out. We're expecting it to reaccumulate in here, and it does that. So we start to rally up a little bit, small little fair value gap in here, runs again, taking out this short-term high, and ultimately runs above this area here for buy side liquidity. Low resistance liquidity run signature here, lower highs to the right. So it showed pretty favorable price delivery as it made a run into here and here. Interesting point you want to have on your charts as well. 12:30 p.m. Eastern Standard Time, the Fed chair, Powell, spoke, and that basically made the low here. 15-minute time frame on the dollar index. Okay, here's our chart. Take a look at that, and if you're not ready for the annotations, pause the video. All right, so here on the 15-minute time frame, again, you can see that daily fair value gap, the movement out of that, optimal trade entry, trades into it here, the 12:30 Powell speaking. So they dropped it down into his speech, created a breaker, low, high, lower, low. Price makes a run up into this high, but notice what's going on here. Every order block finding sensitivity, order block finding sensitivity, fair value gap, consequent encroachment, and it's a mitigation block. What is that? Low, high, higher, low. Last up close candle, extending out in time. We have converging bullish premium PD arrays. a fair value gap within a mitigation block and inside of a run to this high, with institutional order flow being bullish. Multiple order blocks suggesting that order flow is in fact bullish. Every up close candle is being broken as it trades through it. So that's bullish institutional order flow. Moving on into euro dollar. This is our daily chart. Okay, if you're not ready for the annotations, pause the video. Okay. And here is the annotations for our daily euro or fiber chart. We were looking for this fair value gap and a run below this short-term low, and we're, by all indications, it looks like it's trying to do that. We did trade through the rejection block of this swing low, which is interesting. I'm anticipating a denial of that. We don't want to see any kind of pull up in price from there. We want to see it just erode, maybe even gap lower on the opening later on Sunday. So we'll hopefully see if there's a further weakness on euro and upward pressure for dollar. We have this down close candle here, which is the bullish order block inside of this larger order block on the higher time frames. Now, the weekly fair value gap in here also is a factor. So we have multiple converging discount arrays. Fair value gap here on the daily chart. We have old high order block in here within a fair value gap on the weekly basis. So we did have sensitivity off of that bearish breaker here and expansion on the downside. So it's very pleasing to me as a mentor to see the things I draw your attention to and keeping your focus on those instruments and those specific elements to price and then watching them develop over time. This is mentorship. It's pointing to the things with the logic as to why it should take place. And then when it starts to develop in your chart, it's very rewarding. It keeps you inspired, it keeps you engaged, and it also deposits experience that you can't otherwise get just by reading a book or showing a hindsight example. Okay, hopefully that makes sense. All right, so euro dollar. This is our 60-minute chart or hourly chart. If you're not ready for the annotations, pause the video. Okay. All right, so here we have again, we run on rejection block. Buy sell liquidity was taken as mentioned in the previous commentary. Fair value gap with consequent encroachment here as well. Mitigation, I taught why this was more important than that of the breaker. So again, if you forgot what that was or why I'm only annotating this and not the breaker, go back and watch the previous recording because I go into great detail as to why that's important and why the breaker is not so much the important factor anymore. We have sell side liquidity resting below here. It took that and inside of another breaker here. So we had two breakers right there that the price went up into on Wednesday, creating the high of the week, and price then made an attempt to run into the sell side liquidity here. So I'm going to talk a little bit about all of this when we get into the 15-minute time frame. But if you look at how price has, after running from the breaker, small little fair value gap in here, it trades into consequent encouragement there, hits the butt end of it there, and then sells off during Friday. 15-minute time frame for euro dollar. Again, pause the video if you're not ready for the annotations. Okay. All right, we created the high of the week on Wednesday, trading up into that breaker or converging breakers, and price broke away from it. Small little fair value gap seen on the hourly chart. You can see it trading into consequent encouragement here and the butt end of it there. And again, all of this run up was ahead of and completed at the Powell 12:30 p.m. speech that the Fed chair gave. Important note is we had sell side liquidity over here. And this dropped down ahead of the Powell speech. Okay, so before the Fed chair spoke, they dropped it down Now, think about what's going on here. They took price below these lows, taking in new sell orders. Sell orders for those that were long and those that want to sell short on a breakout. So this big run on sell side liquidity ahead of a fair chair speaking, they take it back up into the range, counter order flow. In other words, everything's bearish. Everything's bearish on the euro dollar because of the bullishness we've been outlining on dollar. So why are they taking it up here? To take out buy side liquidity. Why would they want to take buy side liquidity? Because before every significant price run that's directional, there's going to be a stop run. That's a signature that I taught for free on the YouTube channel. So if we're looking for reasons for expecting a manipulation, okay, or an upset of short-term order flow, it's going to be ahead of big high-impact Fed chair speakers, FOMC, something to that effect. But it doesn't necessarily mean that it's changing the underlying premise or technical structure of the marketplace. It just means that they're going to be running stops out. So once they do get above these highs in here, it does it on a spike multiple times and then just erodes and goes back lower. Now, we did not change gears. We did not say, oh, we're probably wrong. We were expecting lower prices, and I drew your attention to 2050 on the community tab, just as a way of pointing to something for a public view. Obviously, there's other PD arrays that would lend more precision there, but I just called that out there for just something everybody can watch and just to prove that we can forecast directional bias by having a draw on liquidity. Now, it doesn't necessarily mean it has to go to 2050, but 2050 as a objective, while it's up here or in here, it lends well because it offers a minimum of 50 to 75 pips, which is one shot, one kill framework, at least as I teach it. So the market trades back up into a bearish order block here, last up close candle, breaks down, small little fair value gap, it comes back up into that as well, and back to the old lows, which is a premium array as well. It breaks down, another fair value gap, but I'm not identifying this one here because it's too much clutter. So I'm just drawing your attention to the fact that it's institutional order flow entry drill there as well. And then it expands on the downside. Moving on into cable. Okay, this is a pair I said that it's really being squirrely. I don't trust it, and it's been hands off pretty much for months now for me. But looking at the daily chart here, okay, so if you're not ready for the annotations, pause the video. There isn't a whole lot on this one. All right, so you can see we have the sell side liquidity pool here. Price traded down into that last week. We had a rejection block, it traded to as well, and then rallied higher. And the short-term high here, I mentioned, as we'll see it on the lower time frames, I said that we were probably going to make an attempt to run above that. And the breaker, which is not annotated on this chart, I apologize, but this is a, again, bearish breaker level. And we've been watching to see if it wants to get up into that, and it has yet to do that. And this here, I have a little light bulb here because I want you to take a look at these prices, how the bodies respected a specific price level there and then went higher. I want you to take a look at your charts and try to decipher what that is. I'll show it to you in the lower time frames. But for homework, before we get any further in the discussion on British pound, look at your daily chart here and study what that area here is in terms of a discount array. All right, moving into the hourly chart on British pound. Here's our naked chart. So I'll let you see that here. And if you're not ready for the annotations, pause the video. Okay. So here is the buy side liquidity pool, relative equal highs. And I said on Wednesday, we're probably going to make an attempt to run up in there. I left these fair value gaps for you to outline in the Wednesday discussion. I said, as you can see, there's nothing here. In my chart, I want you to annotate them. And the market did, in fact, trade back down into them. We have almost consequent encroachment reached on here. Some support at the top end of the premium side of the fair value gap. and then finally making a run above, take the buy side liquidity out. And it's interesting, they did not take the breaker out. And I apologize, it should say breaker, not rejection block. But it's in the video, so it's a mistake. So make sure you have this in your journal, because this is an error on my part. It should say a bearish breaker. But this fair value gap down here, the market trades back down into it. There, hits it, and consolidates. Now we're waiting to see if it wants to make a deeper run into this fair value gap. And then there's a smaller one right in here, which overlaps with the sell side liquidity pool and low here. This light bulb is that level I said on the daily chart. Take a look at your daily chart, scroll back and see if you can find out any important discount array that would justify me annotating the chart showing you this level here. If you don't know what it is yet, go and look in your daily chart and study what it is, because I'm about to show you what it is. It's December 13th, 2019 high. So it's finding support at that old high. Now I already know some of you, really? That's classic support and resistance. Well, old highs and old lows are PD arrays. We refer to them, but there's not always a specific bounce at the high or the low. But I felt it was interesting here, because once we took out the sell side liquidity with this run here into the rejection block, as I annotated on the daily chart, price came back up, hit this low here, consolidated, created your classic continuation pattern of a bull flag here, and then delivered it on the upside, but started creating all the PD arrays that we look for that are much more specific, and they started operating with their delivery on the basis of those, not just simply a support and resistance idea. So the continuation of cable will be had in the 15-minute time frame. So if you have not made yourself your annotations yet on your 15-minute time frame, pause the video, because I'm about to show you mine. All right, so here's the buy side liquidity again taken, and this was delivered on that 12:30 p.m. Eastern Standard Time, Fed Chair Powell speaking. So I'm annotating the chart. You want to have these types of annotations on your chart, not just having, buy side imbalance, sell side imbalance, fair value gap breaker. That's important, but you want to also include the catalysts that were around at that same time. Any news driver, medium impact or high impact, you want to have that in your chart. That's what's in my charts. So to help you understand the logic as to why the price is running to these particular levels, taking out liquidity or engineering liquidity, those elements are important. And then what will happen is you'll have a greater appreciation for when we talk about the calendar, because I know some of you, especially for the new group that's about to start on the 27th of January, they're going to come in and they're going to say, okay, well, what's the big deal about this calendar? By taking these events and applying them to your charts, which is what was taught all throughout the mentorship, but very few of you were actually doing it. When you have these things put on your chart, it's not just lipstick. It provides framework and logic as to why price has done what it's done. So when you start looking at future references to the calendar, whether I'm drawing your attention to it or whether you do it in your own analysis, you'll know the possible scenarios that would pan out around that economic news driver. So while it's not always, okay, if we're bullish, it's going to go down and take sell stops out on a medium or high impact. It's not always the case. Sometimes they'll run into a liquidity pool ahead of it and then use that as a reversal. So it's a matter of knowing what the structure is. And I outlined the buy side liquidity pool on Wednesday's video, saying that they're probably going to want to take it up there, and we'll be interested to see if it does that. And we did see that on Powell speaking. It ran up there, took the liquidity out, paused in here, and then broke down. Small little fair value gap in here, trades up into that, and this becomes a balanced price range. What makes it a balanced price range? The fact that we had a gap here, then we traded down through it. So we had buy side offered, sell side offered, so it's balanced, and so it comes back up into it, and we're not supply and demand. We cut through candles. This is logic. You will not see this in supply and demand theory. It's not there. No one talks about this stuff because I'm the only one that revealed it. When you look at price and you start seeing these things, it gives you the real support and resistance idea. In other words, you see these things here, and this is exactly what the book try to push on us. You try to indoctrinate us saying that support and resistance is so easy. Now, clearly, there are times that support and resistance ideas are classic in the sense, but when you trade them with live money, you're going to find that it's not as clear cut as you want it to be. But these concepts that I'm giving you are more precise than anything else. And the only way you're going to learn to anticipate them and understand them is to dress your charts like this. And it's going to take time. It's going to take time for you to absorb the information and build pseudo experience, because that's what this is doing. It's tricking your brain into thinking that you saw it beforehand, just like the hindsight examples do when you're reading all those retail books. But that logic is flawed. I'm giving you the opinion of what I think is going to happen in the marketplace. I'm giving you the specific levels to draw your attention to before it happens. There's a completely different paradigm shift that's taking place here. So it's important, and I'm really speaking to the new group because everyone else has been here for a while. I'm preaching to the choir. You all know this. But the new group that's coming in, it feels like, well, this is not as beneficial as if you would just tell me when to buy, put a stop, and where to take my profits. By doing these things here and studying what I'm drawing your attention to in the annotations and in the commentary and where I call the market to, you will by default learn how to do those things because of the lessons in the content, and it will be more meaningful to you, and you'll have a greater appreciation for the development process because you have undergone all of the necessary requirements that just simply reading a book or watching a video isn't going to provide for you. You have to do these types of things because it teaches you the skill set of deciphering price. This is the language. This is the way of drawing the important points out of these squiggly lines that these candles create. There's a narrative here. And when you start seeing it over months, not days, over months, then you will start to see, wow, yeah, it really does move on this basis. It really is algorithmic. It's not random. Right. And then once that happens, you're convinced of what you're learning is in fact real. It's not contrived. It's not made up. It's not, some gimmicky thing. It's 100% controlled. So if you can get to that point, it makes it easier, but it's very hard for many people that come into the mentorship because they just struggle with this part. They think it's just lipstick hindsight. It's not beneficial to them because they're wanting signals. And that's why I make it very clear in the enrollment process. It's not signals. I'm telling you where it's going to go. I'm teaching you how to find the setup. But when you submit to that and you study it and practice it and look at your charts in hindsight, and then when you have the availability to watch it develop live, that epiphany, that moment, that aha, I see it. It's something that every one of my students, when they have it, they're treasured in it. It's a milestone that they know exactly when it happened, what it was found on, the feeling that they had, and it's huge. It's such a huge, just a beautiful experience, and it's very empowering. It keeps people motivated, and it motivates you to learn more because you see the fruits of your effort. But it doesn't happen right away for everyone, so it's important you know that that's a normal function in this process. Some people take a little bit longer, and there's nothing wrong with that. But you have to put the amount of effort into it that would be reasonable to see the results. So we're looking for a deeper run into this fair value gap here. There's a sell-side liquidity pool resting below that. So we're going to see if it has a willingness to go lower. There hasn't been any real stop runs. We do have a small little imbalance here that came back up and filled in. But I want to see if it makes a run into the 135.60s, 135.50s for cable. All right, so we are in the teaching section or portion of the weekend commentary, and I'm going to cover pretty briefly. I'm not going to go crazy with it because a lot of this stuff is actually taught in the core content in later months. And those of you that are charter members, you all know this. This is like the back of your hand stuff. But corn as a mega trade. Obviously, throughout the year, I mentioned in the summer months and leading up into the fall that I said that we were going to see a big commodity market boom, and that the grain market would be a market sector or commodity sector that would be an outperforming group. And the reasons why I'll cover again here for completeness sake. But as you can see here, this is a corn futures commodity chart, and it is showing the Commitment of Traders report, and I'm only showing the commercials. Okay, usually there's like the small specs, the large speculators, and then the commercials. I don't care to know what they're doing because this is the group that knows what's going on. They're the ones that are growing it. They're the ones that are buying it to produce food items that you would buy at the grocer. So if you remember the logic around why I felt it was likely to see higher prices, we'll cover them here if you don't. But the US dollar, we've been bearish on it. Okay, and when we have a bearish dollar from a intermarket relationship and a macro fundamental paradigm, we know that that translates to commodity prices being bullish. So it's inflationary for commodity prices. The current economic climate was, and as I indicated, there would be food shortage concerns. And one of the largest dominant users of the grains is China. And the fundamental factors were that China was building up massive reserves for grains in their purchases. So there's a lot of people in China, and their concern for making sure they had enough food storage for 2021 was the basis for why I called this higher. And you can see a lot of the grain reports, they were showing not enough production for the expected consumption of the purchases that China was looking to purchase. And the commodity sector relative strength, I pointed your attention to the grain complex as a result of all of that. All right, so we're looking at the daily chart, and this is the March 2021 futures contract for corn. And right away, I want you to just take a look at this and think to yourself, what in here, especially for the chart, this is more or less the best review perception is from those that are charter members, or at least the members that have gone through the mega trade portion of the core content. But for those that haven't gotten that far, it'll still be inspiring. If you look at the price and then you add the open interest again is something I teach you in the core content as well, and I've also taught on my YouTube channel. But nonetheless, this little purpley, I guess, line kind of looks purple to me. I'm not sure exactly what color that is. We'll just call it purple. The decline in here, while we're in consolidation, this is your first tip off. Okay, that we're seeing short selling collapsed by the commercials. In other words, they're not heavily net short. They're not trying to sell short. Why would they do that? Because they anticipate higher prices. And then there's a little bit of a buildup in here. What's that? It's just people accumulating all this as it runs below and takes out liquidity. So all of this or here is them accumulating the sell stops as it runs below there. Then another dump in open interest. This means that there's really no real interest at all to sell short. Otherwise, when we see open interest increasing, what that is it's noting and recording the hedging that takes place. Okay, imagine that you are a Nabisco in the United States. Okay, and you do a lot of crackers. You make a lot of crackers, and you require corn to do that. So you have to buy corn and lots of it. So as price goes up like this, they're buying corn at a very large rate and amount. The reason why they're doing it is they're locking in that particular price. So as price was going up, they can't wait to buy their corn when it's over here, because they're going to be paying almost $1 more, and they can't absorb that, and make as much profit as they want to. So they start locking in and buying as it goes up, which is being indicated with this open interest increase. But there are huge dominant players that are going to be not willing to sell short. Okay, so in other words, they're not willing to take the other side of the trade. So what that does is it feeds itself. It creates big parabolic price runs higher, and it also indicates, with like an X-ray view, a real supply and demand imbalance. And what do I mean by that? We have consolidation in here when the market's consolidating, but I've already given you this year that dollar was bearish, so that means commodity prices are bullish. So if we see a massive decline in open interest, that's an indication that we are seeing a covering of short sellers. Short sellers on a grand scale, big, huge commercial producers of it. So if that's the case, we have a bullish market in a bullish market sector, which is the commodity grain complex. And I outlined the soybean market, which was the relative strength leader that was not making these lower lows here. So soybeans started the move higher, but I mentioned that it would eventually translate into corn. And corn was, in fact, what you see here. Slower to start, but still over $10,000 per contract nonetheless. Every time the open interest declined while we're in consolidation, that is, again, short sellers covering their shorts. They don't want to be short. Why? Because they expect higher prices. So they're not trying to sell short and lock in their side of the profitability, but there's still always large conglomerates that have to buy it, and they lock it in. And that's why you see this increase of open interest being recorded. This is a 50-day moving average. Now, right away, you're thinking, oh my goodness, this is blasphemy. ICT has a moving average on this chart. What is going on? All I'm doing is drawing a further correlation to the fundamental foundation to mega trades that I derived from Larry Williams' 1970 book, How I Made $1 Million Trading Commodities Last Year. I mentioned it and discussed it in the very specific chapter in that book in my most recent YouTube video. It was chapter 4 of that book. And everything I'm going to show you here is right out of that book. Okay? And it's important because I do lean heavily on this foundation, and then I apply all the intricate facets of price delivery on top of it. But if you're going to be trading commodities, or if you're looking for big mega trades, you start with these ideas. Everything to the right on this over here, all this is important stuff, but nobody thinks about that. They just look for the overbought, oversold, divergence, harmonic, all the supply and demand zones. None of that's going to work, just like an order block would not work unless you have the underlying premise correct. And that's why you want to focus there. So if you don't have the macro perspective, deciphered, and if you're not on the right side of the marketplace, all the things that you're using to time or select a setup is flawed. So you have to have a real sound logic as to why the market should move, which again is mentorship. I'm giving you my experience. Just watching these videos, people have shared them, in recent years, and these people still struggle. And a lot of them email me in honesty and say, hey, look, a friend of mine gave me some of your videos and I'm watching and I don't understand. I know I didn't pay for it, but would you be kind and show me how this works and what you meant here? And no, I never reply, and I ban that email address. I don't want to hear from people like that. So it's beneficial for you to go through these things and resources that I point to because they were milestones in my development. There isn't a lot of them, but the things that I did learn from, I give credit where it's due, and where the impact it had in my development or how I decipher price, I point to that person or that thing that I got from them. And if I changed what it is that they did, I tell you how I changed it. Or if I say this is what it is, this is what it is. As you'll see in that 4th chapter of that book, everything I'm showing you here is exactly right out of that book. And I gave you a real world example of calling these markets beforehand based on all of this. So if we look at the moving average, or the 50-day moving average rather, from July, it starts to turn, price goes above it, and now it's starting to trend higher. Okay, so what's the trend or directional quote-unquote bias of that 50-day moving average? At this point, it's now sloping up. By itself means absolutely nothing. But when you start combining institutional order flow, do we see this breaker finding support and rallying? Yes. It trades back into it again here. Does it rally? Yes. So now, yes, this moving average, while it's indicating it's quote-unquote bullish from a retail perspective, we're looking at the fundamentals with open interest declining in an underlyingly bullish market condition for commodities and grain specifically. Dollar bearish, higher prices in commodities are expected. That right there starts the whole chain reaction. If you don't have that, everything else is going to fall apart. It's going to be useless to you. But if we add one more dimension to this, okay, so now we're going to add sentiment. All this is a Williams percent R 10 period. Okay, 10 period Williams percent R. If this moving average is sloping up and institutional order flow is bullish and all of the PD arrays are lining up and it's giving you the indications that it's in fact going higher, every bullish order block is reacting with higher prices and every premium array is being broken to the upside, that's indicating that institutional order flow is bullish. So now think about what you've just heard me say. You're taking everything that retail sees and has faith in on the face value of it, but applying it with the real underpinnings of the marketplace. When it's so one-sided, then you'll get these results that you're looking for with retail concepts. You'll be able to ferret out when it's really likely to move, and then the indicators would show in hindsight, oh yeah, it worked there. But nobody has the logic behind why it should work. They just go into the indicator. Okay, so what's happening after we had this run on stops here in August? Market sentiment was what? Extremely bearish. Okay, everything on the low end here is like oversold. Think about it like that. But this is the sentiment is it's bearish. Then the market runs up and starts creating what? Overbought scenarios. This is where retail, and then I fell victim to this early on in the 90s. I said, okay, well, since it's up here, it's time to sell short. No, it's not. You wait until sentiment becomes bearish again. That means it's got to get below 80. 80 or lower, that means sentiment is bearish. That means retail is going to see this as, okay, it's going down now. Well, what is the underpinnings showing here? Order flow is breaker being retraded to. We have order blocks in here that's traded to. And institutional order flow is bullish with a bearish dollar. Grain complex is bullish. Soybeans is already tearing off higher. So corn is bullish. When retail sees it as what? The sentiment in their eyes is bearish. So I don't look at this as overbought, oversold. I'm looking at sentiment. That's how I use percent R. Williams percent R I use just for sentiment reasons only. So if they're viewing the market as bearish here when it's underlyingly bullish, then you can pair up your PD arrays on a discount basis and feel more confident that you're trading against the retail perspective. Retail sees it as bearish. Well, if that's true and your underlying technicals suggest that it's bullish in an underlyingly bullish commodity complex like the grains, with all these fundamental factors on the right-hand side together, combining, you have like this perfect tug of war between weak money and strong, smart money. And you can be on side and feel confident. And then the market starts to trade higher. And the whole time it's staying overbought, people are trying to sell short. And that's not what you do. You wait to see if it wants to create another opportunity. It starts to decline in here. We're at a point where sentiment is bearish again, when everything else is relatively bullish. We're trading into fair value gaps with bullish order blocks in here. And while sentiment is bearish, buying discount arrays here. You have optimal trade entries in here. And the market starts to rally again. Only focusing on when sentiment is bearish. Market is extremely bearish here. So market trades down in here, and this is what led me to talk about corn. I said corn is going to be next. We're going to see corn rally, and it's going to try to catch up with what we've seen in soybeans. Another dump in open interest while consolidating, and sentiment is bearish. Off to the races. So $10,000 of a price run, that's a mega trade to me. Okay, that's a huge move for corn, and I shared on my community tab rather facetiously that the news headlines we're able to see in price before the news headlines print. I said to you all through the summer, I said China is going to be buying tons of soybeans. They're going to be the dominant consumer of the purchasing power behind what drives soybeans higher. And it's going to eventually go into corn and eventually go into wheat. Well, here it is. This is it. Now, this is what I'm referring to, again, because I want to draw a differentiation between what your expectations are when you come under a mentor like me versus the reality. I'm telling you beforehand what's going to happen, which forces you to study why I'm saying what I'm saying. And then I go into the reviews and tell you the exact things that I use to go into that analysis decision. Over time, this teaches you the very thing that you came here for. And I'm not spoon feeding you. Here's a trade. Here's a trade. Here's a trade. And developing codependency towards me. You're learning how to do this on your own. And that's why I say all the time, lazy cannot survive here. And this is why I make it very clear that I'm not spoon feeding trades. But you're not going to find someone else out there that's going to lay these types of trades in your lap. They're not. They don't exist, folks. Okay? They don't exist. And I challenge everyone to always look for it. See if you're finding anybody else calling it out like this. And the argument is that you are not getting the buy and the sell, the entry, the stop, and the take profit. That's a derivative of you knowing what it is I teach in the lessons. That's what keeps me within the scope of legality. I don't operate as a financial advisor. I'm talking about price action. And I'm talking about it in the scope of the law that is over me in the United States. So I talk in a way that is just vague enough for you to know that it's not a trade signal, but you know by the language I'm telling you where to go in this information to get the very thing you're looking for. So what did you glean from this lesson? Well, some of you said, well, this just confirms that you know what you're doing. Okay, great. Put that aside for a moment. I want you to think about what I showed you here. I rung in market sentiment. I showed you the real view of using retail tools against the retail crowd. Now, some of you say, oh, this is obvious. Moving average is up, the trend is up, and you only buy when it's oversold. Yeah, that's pretty much it. But how do you get to the logic that just because the moving average is going up, that you can trust it? You need all these things over here. These are the missing pieces I had not considered or even learned back in the 90s. When I first started trading in 1992, I had no idea this was even a factor. I had no idea. I didn't read Larry Williams' book until 2 years later. Now think, 2 years later, I was burning accounts all through that time because I did not understand all of this stuff here that sets the tone for a mega trade. Now, can you buy or read Larry Williams' book, How I Made $1 Million Trading Commodities last year? Can you buy that book and know exactly what you're going to do and how to trade and everything else? I think you can, with a lot of trial and error, just like it did me. And I think that's the reason why that book doesn't get preached about, because you have to learn a lot. And that's the stuff that I give you in mentorship. Those lessons, these boring, dry commentaries, these little talking points that you just want to get me to the point Okay, just get to the point, ICT. The point is, these are the things that you need to know. Whereas I show you a chart like this. Okay, if I put this chart on my YouTube community tab, people would lose their mind because it's got indicators on this stuff, and they're going to say, oh, look, he's trading on indicators. When it's this stuff over here, and order flow is the real intricate parts, but the foundation remains the same. There has to be some fundamental basis for these big, large moves to happen. And here's the wonderful thing. They can't hide it. They can never hide these price moves from you. So this is why I reminded you all, you're not missing anything. You're learning this logic. You're learning this framework, this process of how to find these things every year. Every year, there's big moves like this. Every single year. So it's important for you to relax. Go through the process of putting on a full calendar year with me, walking through the entire year, looking at what we're looking for, the signatures in price, the fundamental drivers beneath the price, especially when we're talking about commodities specifically. And when you have that underneath your belt, that is experience that will carry you for the lifetime as a trader. And you'll be able to refer back to it. But you're learning all of the necessary things that buying courses, buying books, buying workshops and such, they don't give you. They're not walking you through the entire year. They're not walking you through the process of what sets up these big moves. They're not doing it, folks. They're not. There is not another service out here like this. None. And I do this every single year. It's stuff that repeats all the time. So when you look at this and you think, man, I wish I would have been able to participate in that $10,000 move or that $25,000 move in soybeans. ICT, it would have been nice if you would just gave us that trade. Well, I'm giving you one better. I'm giving you the roadmap of how to find it every single year going forward. Because they're going to occur. These big moves always happen. Some of them obviously bigger than others, but you can make fortunes if you are focusing on these types of price action moves. But you need to understand these principles over here on the right hand side. You need that. Because if you don't have that logic, everything you look for will be flawed. I'm going to close it now. I will catch up with you by way of my YouTube community tab, I'm certain. And if not, I will definitely be talking to you in the Wednesday video, obviously. Otherwise, I will talk to you in the Wednesday midweek review in the ICT mentorship. Until then, be safe.